Okay, ladies and gentlemen, we are going to start the webinar. I'm glad to see everyone on the webinar. My name is Stanislav Bernuhov and we are ready to start now. I hope that you hear me well. Let's once again check the sound. Okay, so you can use questions chat or the general chat. I don't know whether you see general chat or not. And first, maybe first 40 or 50 minutes we will work in a listen-only mode. So I will speak and you can make comments in the chat. You can drop your questions in the chat. And after that, if somebody would like to ask questions with a voice, you can send an inquiry. I can add you to the voice conference. Yes, you can ask any questions related to trading. I will do my best to answer all of your questions. Yet the topic of today's webinar is indicator-based trading, simple approach to decision-making process. Okay, I will say a few words about me. I'm a full-time trader, mostly day trader and swing trader, trading on the Forex market, on the currency market. I have pretty wide experience in different markets, and this time I will talk about indicators because many traders are interested in trading with indicators, and I was also trading futures and CFDs. Well, futures and CFDs are also financial instruments, just like currencies, just like Forex. It is out of the topic of our webinar. You know, it's commodities like crude oil, like gold, like stock indices. It's all futures. Today we'll talk about currency pairs, about traditional Forex. And today we will cover several types of indicators and their application in a real market context. I've been trading for over 11 years now, and I was trading in various markets, and my favorite market is Forex now because it allows to capture really good opportunities within a day or a week, employing short-term trading style and short-term perspective. First of all, I suggest you to listen to the information, make notes if necessary, and if you have any questions, you can ask all of your questions in the end of this webinar. And before we start, traditionally, let's take a quick look at the disclaimer. Please be aware of financial risk associated with financial markets, associated with trading. Every trade you make can generate loss, and you will have full responsibility for any of your trading decisions. And please know that past performance is not a guarantee of future returns. Well, I guess that some of you may have pretty wide experience in trading, so I'm not thinking that all traders here today are beginner traders. Well, talking about me and my experience, I would say that first I was trading without any indicators. When I started to trade full-time in 2008, I was not using any indicators at all. I was using naked price chart. But now I'm also using several indicators because they don't affect my trading decisions, so I use them just like tools. And I will show you in this webinar straightforward and simple concepts for using these indicators. Okay, let's proceed. And the rule number one, there are two major approaches in trading. First, some traders rely solely on indicators. Traders think that indicators will solve all their problems. They rely too much on indicators. And the second approach is when trader uses naked price chart, never using any of the indicators. I would say that I've seen many successful traders employing the second approach. They don't need any of indicators. I also was not using any indicators for a pretty long period of time. But now, after 11 years of trading, I use some of them. But they are not sources of signals in my trading. My basic trading idea is not built upon any indicator. They just help me to measure distance between entry and stop loss level in some cases, or identify trade location and do some other things that are pretty useful. So The rule number 1. We build a trading model using indicators or set of indicators, and this model can either be effective or not effective. Indicator can't work or not work. It is just a tool. We are responsible for formulating our idea and the trading model. And the rule number 2, indicator is just a tool. It can help you organize the data in a process of capturing information and distinguishing signal from the noise. It can also help you execute your trades better. But each trading idea must be based on your market understanding. Okay? So that's rule number 2. From now on, we will proceed. Let's talk about different types of indicators. I don't know, guys, what types of indicators do you use. You can use chat and write down your favorite indicators, so I would know better about your tools. As for my tools, I use 4 types of indicators. First is indicators of deviation. Sorry, just 1 minute. Indicators of deviation. I will, just a minute, guys. I will use another drawing tool. Okay, let it be yellow. Indicators of deviation, such as envelopes, Bollinger Bands. Well, most of the time I use envelopes. Then it is indicators of destination. Many of you use moving averages. I also use moving averages in my trading. Some traders use derivatives of moving averages, such as MACDs and stochastics. Well, it's not a derivative of moving average, sorry. MACD is the distance between moving averages. I don't use it. I will explain later why. And the third one is indicators of volatility. It is average true range. It is very, very important indicator for every trader. And the fourth one is indicators of momentum. It is RSI, MACD, and others. Just a minute, guys. Just a minute. I'm first time with this platform, and Okay, let's switch for the next slide. By the way, do you see the next slide? It is called ATR, or average true range. Do you see the slide? Okay, I guess you must see the slide. You must see the slide. Okay. Just a minute. We have, if you have any issues with English, we have here the support team that might help you. I will add them as a panelists now, and they might help you with the language. Give me just 1 minute. Okay. All right, let's move on. So the first very important indicator is ATR, which is average true range. With ATR, we can measure average volatility of the noise within a trading session. It goes from low to high values, and if we have to identify trade location for entry, or measure distance between our entry and a stop loss level, or measure our target, we can use ATR. It is based on so-called true range, or TR. TR is calculated by the formula that you see below, and ATR takes average of these 3 formulas. First of all, it takes 3 values, it makes an average of 3 values, and measures the historical volatility. There are 3 applications of ATR, and the first application is ATR for stop placement. If we don't have any idea of the support level or resistance level, if we don't have any idea of when to place our stop, so I guess that we want to use ATR for measuring this, for measuring our stop loss level. For example, let's imagine that you have entered the position on a, sorry, I will use the pen color. Okay, for example, let's imagine that you want to enter a position right here and you don't know when to place your stop or where to place your stop. You measure the value of the ATR. Measure of the value ATR, it can be, for example, I don't know, 20 pips. You multiply this value by 1.5 and you get 30 pips for your stop. You place your stop and you proceed with your trade. That's the first and a very easy application of the ATR. The second application for ATR is target setting. You can set your daily target relying on average volatility measured by the ATR on a daily chart. For example, if you estimate average length of the bar or a candlestick, you can expect market to stop at some point or at some level and align your target with this level. When you switch to daily chart, you see that every candlestick or every bar is not elongated, so they are possibly, they look more like dodges. And you know that average value of ATR can be equal to, I don't know, 70, 80 pips. Sometimes it can be 100 pips. And I will show you some figures now, an Excel sheet, Excel calculation, and it shows that through the years, if we take 2,500 days, we have volatility of the current day or each day close to 1%. It is close to 100 pips. So how can we use this information in our trading? For example, if you have entered the position somewhere on the chart, you have entered the position and you know that market has already generated 30 pips from the low. Sorry, my drawing tools, they are not very good here. I hope that you see what's happening here. And you have 70 pips more. You have 70 pips more if you know that average volatility of the day is equal to 100 pips. You have 70 pips more, and here is your target. So you will set your target equal to 70 pips. That's the concept. It is pretty simple and it's pretty straightforward. Now I'll watch the chat. I will watch the question. My audio has a problem. I don't know. I don't know. By the way, besides, do you hear my voice? Let me know if you hear my voice. I guess that everything should work good. Yes. Let me show it on MT4. Let's switch to MT4 trading platform, and I have here 30-minute chart. Let's switch to daily chart. Let's switch to daily chart, and let's apply ATR, which is average to range. I normally use 21 parameter for my trading, and we have daily bars here. Daily bars. So if we look at the ATR, we see that it is equal to 0.0134. It is 134 pips. It is average volatility of the day. So if you want to enter the position at some point, you're going to set your target using these statistics. For example, let's imagine that you have entered a position right here yesterday at 1.3743. The high of the day was equal to 1.3786. If you measure 100 pips below, you get 1.3686. Or the ATR, or the daily ATR is equal to 130 pips, so it is 56, right? It is 56. It's your possible target. Well, the market is not going to touch this target 1 pip, okay, 1 or 2 pips. And you don't want to set your target using the exact parameter. You want to take something less, for example, 100 pips. And that is the distance. So that is pretty simple application of the ATR. It is a target setting. Okay, let's move on. Okay, let's move on. And the third application of the ATR is when you don't know the destination of the market, you can use volatility, because ATR is moving from high to low values, from low to high values. Volatility switches from the low to the high. And when you don't know where the market is going to go, you might capture the lowest values of the ATR for the period of 3 to 4 days. It's pretty good setup to trade. For example, if you set a 30-minute or hourly chart and you see that at some point you see the lowest value of the ATR for the 3 or 4 periods, 3 or 4 days, and at the same time you see very narrow trading range at the beginning of the day at the Asian trading session, you can start trading this setup to both sides. You can trade a breakout momentum trade to the upper side of the range and to the lower side of the range. For example, here you can trade to the upside or to the downside. It doesn't matter. It will work in both ways. Just a minute, guys. Let's switch to MT4 and apply ATR to MT4 trading terminal. Well, you see here M30-minute chart, 30-minute chart, and when you see that the ATR is the lowest for the period of 3 to 4 days, like it was on February 15th, we have pretty narrow trading range here. Well, nothing had happened at this day. Really, at this day, nothing really happened. But when you see at the February 22nd, it is yesterday. We see pretty narrow trading range once again. It's pretty narrow range once again. The first breakout is false, and the second breakout is genuine here. Well, the day is not trending at all, but nevertheless, you can enter a short trade here. But the primary trading range is very small. You have a couple of false breakouts, and the third breakout is good one. That's not a good example because in some cases market it breaks very nice, and it shows you very good setup, like it is shown, for example, at February 5th. Please note that ATR was the lowest at February 5th. It was the lowest for the period of 5 days or even more. And you set this, and you measure a trading range. That's the way it works. And then you can trade a breakout to the upside or to the downside. You may even be stopped the first time. At the second time, you are going to enter a position, and it should work pretty accurately. You would capture a trending day here because the volatility is the lowest. And that's the third application. Okay, let's once again go through ATR. That's my favorite indicator because first of all it allows me to estimate stop loss level. For example, when I don't know when to place my stop, if I want to get inside a trade, for example, I work with a trend. Let me delete all the indicators here. If I want to go with a trend, if I want to capture some pullback like it is shown here, I don't know when to place my stop because all major levels of resistance are located above. They are pretty higher than the current price section. If I want to place my stop, I identify the trade location and I use ATR. For example, in this case it is equal to around 14 pips. I multiply it by 2, I get 28 pips. I get 28 pips and I place my stop. So if I have no other ways to set my stop except ATR, it is the best way to go because it is historical volatility. I hope that you have understood this concept. It's pretty similar to other concepts. It's pretty simple. If ATR is higher, then the breakout is happening. Sorry for bad English. No, if the value of the ATR is low, then the volatility is about to expand. Then the volatility is about to become higher, right? So when the value of the ATR is pretty low, for example, like we see it here, we see the lowest value of the ATR for the period of 5 days. And you see at the chart, you watch the chart, and you see that the trading range is pretty small. So you want to trade the breakout from this trading range because the volatility is going to become greater. Okay, it's going to become greater. You can set your sell stop order to get inside a position. It is pretty good for a swing trade when you hold your position overnight. This time it works pretty nice. You have a pretty good trade location. Also, Monday is also the day with the lowest value of the ATR, but this time you could only catch the small deviation here because market was not really ready to go. This time it was ready to go and it was pretty good trade location here. Okay, let's move on. That's about ATR. I will later on show you a couple of examples when we use several indicators at the same time. Let's talk about indicators of deviation. One of my favorite indicators as well is envelopes. It measures deviation from the mean, and the mean in this case is identified with moving average. In a nutshell, when we trade, we want to know where the value is and where the price is. We don't trade price itself. We trade price in comparison to the value. We always have to compare, right? And when we apply envelopes, it thinks that the mean or the value is a moving average. So it thinks that the moving average is a substitute for a value. And it measures the deviation from the mean. We have several bands here. It is upper band, lower band, and the middle. The middle band is moving average, and the upper band is the upper value of this indicator and the lower value. Let me build this indicator in the platform. Well, we have several parameters here. First of all, it is period of time. I set it equal to 21, and the second lead is deviation. I set it equal, for example, to 25. Well, but this parameter has to be optimized every time because the volatility changes dynamically as the day goes by. For example, how to optimize this parameter. For example, you see that if I want to use envelopes within a day of February 19th, I see that here I have a low. So I have to increase the parameter of deviation, for example, to 35 to make the lower band correspond to this low. Okay, now I optimize this parameter, right? When the market becomes less volatile, for example, and it establishes a new low, I also change my parameter of deviation. I set it back to 25 or even less, 22, and you see how it works. Volatility becomes lower and the deviation also becomes lower. I'll explain you now how I apply this indicator in in real-time mode. Can we zoom presentation a little more? Okay, I will try to. Let me try to do that. Is it better? I guess that it is the maximum size that I can achieve. All right. That's okay. And when you apply ATR to current market activity, you might think that at the first sight it is very easy to spot reversals, placing your trades at the lowest and at the highest bands of the envelopes. That's the first thought that comes to your mind, right? That's the first thought. You might think that, all right, I will sell here, I will buy here, I will sell here, I will buy here. But in reality, it is not so easy. It is not so easy because it works only in a balanced market condition. When you know that overall market condition is balanced, and in this case, besides, you cannot achieve very good profit-loss ratio, because if you just place sell limit orders on the upper band and lower band, you just can't achieve very good profit-loss ratio. Imagine that you have placed buy limit order here and you have some ATR parameter here. You have to multiply it by 2 to place your stop. Your stop loss will be at this distance, right, to get your position secured. And most of the time it is wise to work to the center of the trading range. You never know if the market will go to the upper band. So your predicted profit is from the lower band to the middle. You can achieve 1-to-1 profit-loss ratio in many cases, as well as, for example, if you sell at the upper point, you place your stop and you place your take profit. It is 1-to-1 profit-loss ratio. It is not very good trade. How can we improve the results? How can we improve the results? Well, I would say that you also can use envelopes, trying to establish a position in the direction of the trend. For example, when market is going to break, it is going to generate a rally. You have some primary range, market emerges from this range and it builds intermediary range, preparing for the breakout. And you can use envelopes here to capture a pullback, and only after that market breaks and goes to the preferred direction, right? So that's possibly the best way to go, because in this case you can achieve 3-to-1 profit-loss ratio and even more. You can achieve 5-to-1 profit-loss ratio, or 6-to-1, 7-to-1. Well, it depends on your distance of your stop-loss level, on the volatility. If the volatility is very low, your stop-loss also is relatively low. It's relatively small, and the breakout can be pretty good, and you can achieve up to 10-to-1 profit-loss ratio. It is pretty achievable. And I will show you now the example from my trading. I have my own sort of a trade room. Give me just a minute. Oh, that's it, right? That's it. That's the trade I wanted to show you. I had envelopes here. And I have entered the position using envelopes here. And it was 1.3882, I believe, and my stop loss level was equal to 30 pips. I was using ATR for setting my stop loss level. And then I just captured 500 pips in this position. So I was just using trailing stop in this position. It was January 4th, and after that day we had a pretty good rally on Canadian dollar. So that's the way I have used the envelopes here in this trade. Okay, let's get back to presentation. Let's get back to presentation. What is the best period for ATR, 14 or 21? Well, I would say that if you use 30-minute chart like I do, it is better to use 21. If you use hourly chart, you may use 14 or 15 or maybe less. You can even use 10. So the basic idea that you use the parameter capturing your current trading session and a few hours outside of your trading session. So it's possibly 10 hours. It's pretty good to use 10 hours. It's pretty okay. That's an example. For example, it is also an example of real trade that I have made on my account. It was an initiative break. Market breaks through a long-lasting trading range. It was, I guess, it was the previous year. I also will show you some fresh examples later on. And we have an entry point. We have envelopes set by the intraday low, and we have an entry point, and we have a stop loss using ATR. After that, we had a pretty strong rally here, pretty strong breakout to the downside. So this trade is also pretty good. It had generated possibly 5-to-1 profit-loss ratio, this trade. Okay, let's move on. And I will tell you a few more ideas, and then we will switch to the charts and see what happens there. Now let's talk about, okay, that's one thing more about envelopes. We can capture a pullback in a trending market, but sometimes it's very hard to do because when you have a trending market in place, market never touches the lowest band of the envelopes. You see when it goes higher and higher, moving average starts, it is a lagging indicator, right? Moving average is a lagging indicator, and it can't adapt very quickly. It can't adapt very quickly, and that's why the lowest band of the envelopes is never going to be touched here. So we have a gap between lower band of the envelopes and the current market activity, current price action all the time. And the major mistake that traders make, a very popular mistake, they wait for the breakout, for the culmination, and after that they start to search for trades. They start to capture pullbacks. It is absolutely wrong as a wrong can be, because the phase of the market, the active market, is going from small volatility to the high volatility, to the breakout. And let's once again go to the previous slide and see how trending activity develops. Market prepares for the breakout, and then suddenly it breaks. It's a trending day with volatility higher 2 or 3 times than a normal volatility, and after that, market goes to the pullback and volatility increases. It is, you may see a trading range, and it's not wise to capture small pullbacks after that. It's not wise because the trending move or a trending phase exists only here. After that, market switches from bullish to sideways. It switches from bullish to sideways, right? Okay. Now let's switch to, okay, we have a couple of questions. I'll try to answer them. When we should sell on ATR, please rephrase your question. I don't understand that. Why should we sell on ATR? ATR is volatility, okay? It measures volatility. It doesn't measure any destination or deviation. Maybe you were talking about envelopes. It's not a destinational indicator. It's just a volatility. Okay, we place our stops, place our targets with ATR, and sometimes we pick our entries, pick our timings for entry, but not We don't use it as an indicator of destination. Okay, let's talk about moving average. Many traders use moving averages, but I don't feel that they use it correctly, in a correct way. Let's again remember that in trading we also want to know not where the price is, but also where the value is. So price and value, the relationship between price and value is the most important thing in trading. And when we build two moving averages, basically it is slow one and a fast one. Value area can be found between slow and fast moving average. It is often a fair trade location. Of course it is fair for trending market, right? For example, when you see fast and slow moving average going in opposite directions, or when fast moving average starts to move away from the slow moving average, and you see that the distance between them starts to become greater, and when market or the price pulls back to this area, we can capture a trade here, right? We can capture a trade. I don't use moving average as an indicator for momentum breakout trading. For example, when market breaks, it is pretty hard to capture such kind of trades because moving average is a lagging indicator, right? It is a lagging indicator, and it's better to search for pullbacks than for breakouts. So we identify trade locations with a moving average, and then we have to pick an entry. Some traders may ask, okay, but the value area can be pretty wide. When exactly should we enter a position, or where exactly should we enter a position? And here you can combine two indicators. First, you use two moving averages, and then you use envelopes. And the third one, of course, is an ATR for stop placement. Let's see how it works. For example, let's use, I don't know, Euro versus American dollar. Okay, let's use Euro versus American dollar. Most of the time I use 30-minute charts, and let's apply all indicators here. First of all, I want to use two moving averages. The one, let it be 35 with a parameter of 35. Okay. Guys, do you hear me? Are you with me? Okay, that's good. That's good. And the second moving average with a parameter of 150. Okay, so I have fast one and a slow one. And let's look at the current market activity. And you see that market was entering the value area several times. At February 16th. We had setup on February 16th or February 17th. We had February 18th. February 19th, it is also set up, right? February 19th. And eventually February 22nd. Now let's try to apply envelopes here. Okay, so we set the period of 21 here because I use 30-minute chart. Answering your questions, Ali, I use no more than 3 indicators. So 2 moving averages, envelopes, and ATR. I don't use any more. Okay. Then I establish envelopes here and see what happens here. I want to change parameter of deviation, aligning it with a new low. For example, at February 16th we had a Asian low, so we have to change parameter of deviation. For example, let it be 15. Okay, 15 is okay here. It works. And once market touches the upper band of the envelopes, it is 1.1178, and my ATR parameter is 11 pips. So I want to multiply it by 2 and get 22 pips. My stop equal to 22 pips. So if my entry point is 78, I add 22 pips and I get possibly 1.12, right? That's my stop loss level. Well, it looks that it is pretty distant stop loss level. Well, it is not that distant because in reality you never know where you never know how big this spike is going to be, how big the spin bar is going to be. Okay, one is 150 and the second is 35. Okay, guys, I can send all of you the presentation, and the video will be uploaded on YouTube, I guess. So I guess that we can also provide the recording of this video to all of the participants. So you see how it works? Okay, what if I wanted to day trade? What if I wanted not to hold my position overnight? What should I do here? I switch to daily chart. And I measure ATR on the daily chart. It was, let's remember what date was. It was February 16th. Okay, it was February 16th. Let's watch volatility from February 16th. And ATR here was equal to 97 pips. 97 pips, right? So I never set my targets using this number. I use smaller number, maybe smaller than 10%, to get my target executed. So let's calculate. The high of the day was 1.1191 and the low of the day should be at some point of 1.10, 10.02 or 10.05 or so. Well, this time market was not going to, the volatility of this day was less than average, right? Was less than average. So for day trading, it is not a very good example. But if you enter the position on 1.1190, at the end of the day, you will nevertheless have some profit, right? You will have some profit. You can close this profit. You can fix this profit, and that's okay. On the very next day, again, we apply 8 envelopes. We apply envelopes again. And what do we see here? What do we see here? We use our Asian low. Okay, so we have to use our Asian low here. That's the way it works. It is 1.1118, right? And our upper band of the envelopes is equal to 1.1167, right? 67. Price gets inside the value area, and we can calculate our stop using ATR. It is 10, so our stop loss has to be on a distance of 20 pips. 68, we add 20 pips to this value and we get 88, right? We get this level to place our stop. And again, if we want to day trade, we keep our position and we can close this position at the end of the day, right? We also capture some profit. But if we're swing traders, if we hold our position overnight, we can hold for the next day and wait until the market is going to break. So we will have another 3 days before market breaks. At the next day, February 18th, let's look how it works. We use Asian low for setting our envelopes. Guys, I guess that you catch my point. Yes, both moving average are exponential, right? They're exponential. They are not simple. Okay, so I guess that I should set the deviation equal to possibly 0.13 here. And well, market doesn't touch even the upper band. It doesn't touch the upper band, but if it touches, also I have a pretty good entry point here at just 1 pip, right? 1.1150 is my possibly entry point, and my stop loss should be equal to 16 pips because the value of ATR is 8 here. 16 pips. Well, these days very good because small stop. We have a small stop and we have good profit loss ratio. Market breaks. Well, eventually it is not very good profit by the end of the day. But if you measure the daily ATR, you see that this time market makes the good performance, right? That's the high, 48, and the low is 1.1073. Well, we can generate some profit here. Generate some profit. And the very next day, also we have the same thing, but I guess we might be stopped out. That's the current activity, right? Several days, several trading days, we can capture small profits here if we day trade, and we can capture more elongated profits if we swing trade. And the same thing here, same thing now, right? Market enters the value area. Market enters the value area. That's the value area. I mark it with a rectangle. It is the value area. Let's once again set the deviation parameter. It is very small. This time it is very small. It is 0.10. Okay, and that's my entry point. That's my entry point. It is 1.1043, right? 43. ATR is equal to 10 pips, and my stop loss is equal to 20 pips. 43 and 63 is my stop loss. 63 is my stop loss, right? So if I entered the trade using this trade location and using 1.1043 level as an entry point, so I would have had a good position here. Well, it's not very good position. It's just 40 pips in profit, but it is 2-to-1 profit loss ratio. I already would have 2-to-1 profit loss ratio, and if market continues to go down, I can generate 60 pips more using daily volatility, right? It is equal to 130 pips. I can make 60 pips more. Guys, do you get the point? I guess that's a pretty simple concept. Let's once again get back to this concept and remember how we can apply 3 indicators simultaneously. For example, we use moving average as a substitute of value, as a method to measure value, because slow and fast moving average, when we place these 2 indicators in the market, we can get the idea of the value area. The fast one can be 35 with a parameter of 35. The slow one can be with a parameter of 150. Then we apply envelopes. We align the bands of the envelopes so to have the deviation aligned with the current market volatility. We generate an entry point and we set a stop loss using ATR, right? The volatility of the day can be not very elongated, because when you work inside of the trading range, you can generate, I don't know, 35 or 40 pips. Well, but for some kinds of strategies, it might be okay if you capture small small movements inside of the trading day, inside of the trading range, sorry, it might be okay. So you just work in the direction of the trend. You capture some here, you capture some here, you capture some here, and eventually you can make 3 days with profit of 35 pips each day and generate 100 pips in a period of 3 days. Well, it's pretty decent profit for the week. Okay, about trailing stop, how it works and how do we use it. Let's pay some attention to trailing stop. Well, trailing stop, in my opinion, trailing stop is not a very easy thing to do because when you track your position, you have the market going up and down. Sometimes it goes beyond the previous lows, right? And it never goes straight forward. It never goes just from the left to the right or from the low to highest values. And when you set a trailing stop, I would guess that you will have switched to highest time frame, for example, to daily chart, and use the parameter of ATR from the daily chart. Because once you hold your position overnight, you automatically take the risks of higher time frame. And this time you have to switch to daily chart. See the ATR there, it might be 130 pips, and that is your trailing stop. That should be a trailing stop. It might not be very small, but if you want to survive in your position, if you want to generate some profit, if you want not to be stopped out from your position very quickly, I guess that your trailing stop should be not very tight. As for breakout momentum trades, when you enter your position, well, you might have smaller trailing stop. You might have smaller trailing stop. For example, when you enter your position using morning range, and you have entered your position, well, this time I guess you may use tight trailing stop. For breakout momentum trades, it's pretty okay to have tight trailing stop. All right. Because you work with high price, you're using high price, or when you go to the low, when you set up a momentum trade to the downside, you also use low price, relatively low price. You don't want to hold your position overnight. You want to capture a quick profit within a day or within a period of 1 to 3 days and get out pretty quickly. And this time you may use 2 ATRs on your current time frame, for example M30 or 1 hour, and it will work pretty accurately. As for me, I don't use trailing stops in a common way. For example, if I enter the position, I know that the market is going to test my entry point. It is going to test my entry point. Of course, it is risky in terms of equity, in terms of dollars or cents. When it tests the level and it goes, I know that I want to be in position, so I don't use trailing stop. Instead of using trailing stop, I use several targets. For example, I use first target located at 1 deviation. Then I want to have second target. And eventually I can have third target. That's the way I manage my risk. But it's not trailing stop. When you use trailing stop, you go all in and all out. But I want to have several targets. I know that I should have positions that are not going to be stopped out very quickly. And also I want to generate some profit. I don't want to have very big volatility on my equity curve, so I set several targets. First target, second target, and the third target. That's the way I manage risk. Did I answer your question? I'm hoping that it's a pretty clear concept as well. If you want to eliminate some volatility from your equity curve, you have to have several targets. Will we get notes of this webinar at the end of this webinar? You want to have presentation, right? Well, I guess we can provide you the presentation. There's nothing complicated with that. Let's go once again through the information that I have provided you today. We have a couple of rules. First of all, indicators can't work or not work. We build a trading model using indicators, a set of indicators, and this model can be effective or not effective. We are responsible for the idea. Indicator is just a tool. It can help you distinguish signal from the noise or execute your trades better. But the responsibility for building a trading hypothesis or a trading idea is yours. There are 4 basic types of indicators. There are indicators of destination, which are moving averages, indicators of deviation, which are envelopes and Bollinger Bands, indicators of volatility, which are average to range, and indicators of momentum, RSI and MACDs. I don't use them because basically that's not a very good idea to capture momentum on Forex market, because it is very manipulative market. If RSI, MACD, stochastics can be better used on stock indices, but not on currencies. That's my personal experience. You might have another opinion, I don't know. Yes, I can share this presentation, but we have to choose. I guess we can send a follow-up email for all of the participants with the presentation. I guess that we might do this, and I think we are going to do this way. ATR, or average to range, is a very important indicator, possibly the most important indicator, because it is used for managing risk. It can be used for stop placement when you multiply its value by 1.5 or 2. It might be used for target setting when you switch to highest time frame and you measure average size of the bar or a candlestick, and you know when the market is going to stop or to finish its action for the day. Then you can use ATR for timing your entry when it is showing you the lowest value for 3 to 4 days or more, and when you see very low volatility on the price action, then you can trade breakouts to both sides of the range. You can use envelopes for capturing pullbacks. Especially when you align envelopes with moving average, like it is shown here. Well, here you see no moving average, but you see the trending market. And you can have entry points using pullbacks, right? When you use moving averages, the slow one and the fast one, the envelopes and the ATR simultaneously, you can achieve pretty nice results, because you have trade location with moving averages, you have entry point with envelopes, and you have stop, or you measure your stop with the ATR, and you can also measure your target with an ATR. That's the way it works. You see, that's pretty simple. I don't say that this is easy. There's nothing easy in the market, but it's pretty simple. Okay, guys, if you have any questions, let's go to the questions. That's I wanted to share with you today in a presentation. What lot size do we use with $1,000 account? It depends on your money management, because if you are pretty aggressive and you want to risk 3% of your account in each trade, and if your stop loss is equal to 30 pips, I guess that your lot size should be equal to 100,000 or so, not 100, 10,000, sorry. My Skype, if you want to contact me in Skype, my Skype is Bernuhov. Well, if you like, you can contact me. I'm hoping that we will send presentation to all all of the attendees today. How many trades do I suggest for the day? Well, in my trading, it is okay to have 2-3 trades a day, maybe less. It is about 20 or 30 trades a month. It is okay for my trading. I'm mostly a swing trader. I'm not an active day trader. I'm a swing trader. Can you explain about envelopes once again? Okay, let's go through the envelopes once again. Envelopes, it is an indicator of deviation. It measures deviation from the mean. Let's imagine that you have value and a price. Price gets away from the value and it gets back to the value again. It's getting away from the value and it's getting to the value again, right? Moving average is a substitute for a value in this case, and the deviation measures the distance of possible deviation or the size of possible deviation, right? And we have the picture that is shown on this slide. The center of this range is moving average. The center of this range is moving average. The deviation creates upper and a lower band of the envelopes. The deviation is a parameter that you optimize. You can align this parameter to current market conditions. For example, once you see a high, you want to increase the parameter of deviation to have your upper band of the envelopes fit to this high. Or, for example, when you have a low, you also want to increase the parameter of deviation for the envelopes to have your low corresponding to lower band of the envelopes. Did you get the concept? Okay. That's pretty simple concept. Pretty simple indicators. Well, I'm sure that trading must be simple. It must not be very complicated. All successful trades they look pretty simple. They are not complicated at all. If breaks the envelope, you don't do anything. You just wait until new high or new low will be shown on the market. Well, in my trading, within a day, I use 30-minute chart. You might use 1 hour chart or 15-minute chart. It's up to you. It's convenient for me to use 30-minute chart. You know, time frames is a pretty simple concept. You even can use, I don't know, 20-minute chart or 40-minute chart. It doesn't matter. I know a trader that employs 3-hour chart or 5-hour chart. It doesn't matter. It's just a way to organize the data. Yes, I guess we will upload this video on YouTube and you can see it once again. All right, thank you for attending this presentation. I appreciate your attention, and I don't know what we will do in the next webinar, so please follow your email. I think that you will get all the information on the email. I don't know what exactly will be on the next webinar. There are plenty of topics, plenty of interesting setups, plenty of information. Can I show something in the current market? Yes, let's try to. Current market. Well, I was showing you previously the situation with euro, right? Well, that's not for the present time. The setup setup has occurred on European session after the Asian session. Now it's too late here. As for the current market, let's try to see. I would basically like to see what's happening on the British pound, because it was very. Oh, it is going to the lower side. It's also too late here. Okay, then let's watch through the markets. Maybe it will be something interesting with. Okay, we have Australian dollar right here. It has a good, the previous day, yesterday was pretty good trending day. Possibly we can capture some pullback trade here today. Let's set 2 moving averages. The second should be 35, right? It should be a 35 parameter. Let us install envelopes. Well, I have to change the deviation parameter, right? I have to change the deviation parameter. Possibly it has to be 25 or so, maybe less. Well, I guess 25 would be good. So it is close to possible entry point. And the current ATR is 13 pips. I have to multiply it by 2 and get 26 pips of stop loss. My entry point is 0.7217. So I use 30, sorry, it's not 30 pips, it's 26 pips. To the downside, it is going to be 94, so 95. All right, that's the way it works. And if market reverses from this point, today's low is 0.7210, right? 7210. Let's switch to the daily chart and measure ATR here. It is 85 pips. It is 85 pips. So if we use this parameter of 25 pips, our target possibly should be on 0.7290 or so, or maybe 7280 to take something less than 85, 80, 83, I don't know. But that's our possible target. So if we enter a position right here with a stop loss level aligned with ATR, we get 3-to-1 profit-loss ratio if this trade works. Okay, so let's see what happens on the next day. New Zealand dollar. Okay, let's go through the New Zealand dollar. New Zealand dollar. Well, it's not very good because the pullback is very deep here. The pullback is very deep here. I don't need even moving average to see that the pullback is very deep. Well, if you like, I can build moving averages here. And you will see that there is no setup here. There is no setup because market has come to the slowest moving average, and it has violated the slow moving average already, right? It has violated this band or this moving average, so there is no setup here. I guess that this market is more balanced than Australian dollar is. It's going to generate a rotational move or sideways action, and we should be outside of this market. We should step back and see what happens next. let this market, let the time go, and possibly, maybe we will see the setup tomorrow. As for today, Australian dollar looks better to get inside a long trade. Okay guys, let's get back to the presentation. I guess that we are running out of time, and I appreciate you coming to today's webinar. If you like this webinar, please attend our next webinars. You can also watch videos on Exness YouTube channel. Oh, my Skype is Bernuhov. I don't know whether you have got it. It is Bernuhov. Can we use only one indicator for all? I'm not sure, because each indicator does different job. Well, you can use one indicator. You can use just ATR and nothing more. ATR and a naked price chart. Because ATR helps you to calculate your stop. Risk management is the most important thing in trading. If you know your setups, if you use candlestick chart patterns, if you use, I don't know, you can use engulfing patterns, pin bars, or something like this, using your chart, using your candlesticks, using bars. And if you use only ATR, it will be okay. You can trade profitably. But if you also want to know the value area, know the destination of the market, and fit your, or maybe get the best entry point, you can also use envelopes, because our eyes cannot be very accurate. Sometimes indicator does a better job than our eyes. Okay, now I'm stopping the recording. Thank you for coming to this webinar. I'm hoping that you enjoyed the webinar and you will use ideas and concepts from this webinar in your trading.